Hey, welcome to the Evolution Real Estate Podcast. This is with Justus and Scott. So if you haven't seen this, we used to film these off the side and then upload them. Now we're trying to go live. So it gives kind of an interaction piece for clients or people to ask questions or just listen to us live as we're talking about it. But yeah, Scott, so my name is Justus, here with Scott. So Scott's the realtor. I'm Justus. I'm the loan officer. My job is to help get you financing to buy a home. Scott, give yourself an introduction.
Hey, Justus. Hi, everybody. My name's Scott Ebel. I'm with Greater Midwest Realty, and just excited once again to be here to share some tips, tricks, and behind the scenes of what's going on in the Twin City market. So that's what we're looking to do today. So anybody that's kind of cluing in or chiming in, be great to hear from folks that are out there. So yeah, go ahead, let's go ahead and get started. Now we always kind of start, Justus, and you kind of kick it off by interesting things that have happened since our last podcast, and just kind of segue into that if you don't mind. But for me, I haven't it's been pretty slow, business as usual, really working on taxes, decluttering, and getting rid of stuff, really, for me. But so that's the interesting, really not interesting. I think the more interesting is what you're doing and what you've been up.
Yeah.
Not so much what I've been doing, because I've been doing mundane kind of stuff. But how about you? What have you been doing? Where have you been?
Yeah, where I've been is the real story. Yeah. I mean, this is the time of year usually when people in our industry kind of recharge, take vacations and whatnot. I just happened to travel the world in the last month and a half. So I was just in Hawaii last month, and then I went to Syracuse, New York for a broomball tournament. Then found my way into Tampa, worked during the week in Tampa to visit my brother. And then just last week, we were on our President's Club trip in Mexico and Cancun. So it was my first time there, first time in all-inclusive. And boy, was that a cool experience. So I got a couple images here. So Scott, you'll be able to see it if you're on the restream, but otherwise, so I'm just showing a picture of all the people that were able to make it to the trip. Quite a few loan officers there, quite a few qualified. So, a little bit of a where's Waldo, where am I on that one. And then a picture here with the two other guys on my team, so Matt and Mitch. So anytime you make it to a President's Club trip, they give you kind of like a little token piece on how you did. So the size of the hat indicates how big of a production you did in a general sense. So needless to say, the guy in the middle, Matt, did quite a few more loans than I did, but he's the experienced LO on our team. And then Mitch is another guy there. So this is the view from our balcony. And it was just beautiful. It was unreal. So that's Rachel's back of her head there in that picture. And then of course I had to sneak in a little golf. So can't help myself with that. So that's what I was. And at Bell, it's just kind of one of those things where they reward the loan officers if they hit a certain production throughout the year. So luckily, all paid and all exclusive or inclusive, whatever you want to call it, from Bell to us. So it was a pretty cool experience.
Wow, good for you! Congratulations.
Yeah. Thank you.
Nice sombrero, by the way.
Oh, well, thank you. Yeah, I forgot to bring it here, but I would have had it in the background. But over here, that's the little tiki I got from when I was in Hawaii. So yeah, it's kind of turned into a thing where if you go somewhere, you bring a little token back. So now I got my little sombrero hat that's, yay big. Yeah.
You're going to have to make that thing grow, I think.
Yeah.
A little bigger or something.
Next year, we'll get a bigger hat.
Bigger sombrero is the goal.
Yeah, bigger hat.
More sombrero.
Yeah.
Mucho sombrero.
Yeah, that's about all I know in Spanish too. Luckily everyone spoke English there because I don't know another language. I wish I did, but
I did a couple of years ago. I did get an opportunity to go to Cancun or to Cozumel, and I actually was told by a local that my Spanish sucked. So
that would have been me. Yeah.
yeah,
That would have been me.
he just came out and told me. So I think he had the need to tell me. So good for him.
Yeah.
My Spanish sucks.
Yeah. Yeah,
it was a good time though.
It was a cool experience. Yeah. One that motivates you to try and do it again the next year.
Yeah, absolutely.
Yeah.
Very cool.
So let's see what we got going on in the Twin Cities market, because we know that rates are going up, but do we have any more houses?
Well, tell you what, isn't that the question everybody's looking for, or the answer, the question that bothers us so. So if I can go ahead and share the screen here.
Okay.
It's disabled, so I'm not able to do that right now. But
let's try that again. Yeah.
If you can allow me to share my screen, I can go through some key indicators of the market and what's happening.
Let's try it now.
All right. Let me know if you can see it, Justus, and then we should be good.
Let's see.
You able to see it?
There we go. We are good.
All right. So as we do on this podcast, every time we get together, we kind of look at the market and inventory and some key indicators of the 13 county metro area here in the Twin Cities. And so I'd like to cover that because those are the leading indicators of really what the market's doing, right? And kind of starting off with, as you can see on the screen, homes for sale right now, as of January, are at 4165. So that is, to answer your question, that's what we've got on the market as of January. I know we're into February here, but through January, that's where we're at. So as you can see on the sloping kind of line here, there is not a ton of inventory, even last month, and it's pretty traditional or pretty cyclical that it does the same thing. So if I go back here, you can kind of see in a year ago in December where we're at 57.13, and then in January, February. So it's pretty normal. This over here was 2 years ago, so you can kind of see what it does in the December. So most of the time when homes are hitting the market, I mean, people obviously, because of the holiday season, October, November, December, they kind of start to wane off, and then you've got that 2 months where I'll talk about close sales next. So, for a home to take a couple months before they close, and then that inventory comes off. So, but that's what we got on the market right now in the 13 metro county area, as far as indicated by InfoSparks as of January. So if we look at closed sales, here's where we're at. So closed sales right now, we're through January, it was 2983, which, looking back at a year ago, these are the indicators of what, the traditional cyclical pattern of our sales cycle, right? December here starts to drop off. January, those listings from October usually takes 2 months, like I said, to close, a couple months, and then they fall off, and that's where you see this. And obviously these peaks are, more towards the holiday season. This one is special July, and then October, and then similar June, July is your peak month, and then kind of starts to go down. But months of supply, that's another leading indicator that we always look at. And as you can see, this line chart, continues to decline. It continues to just get skinnier and skinnier and less and less. In 13 county metro area, we're at 0.8 months of supply. 1 year ago, if we look back just even a year ago, I think it's over here, we're at 1 month. And I've talked about that many times, where if no other homes were to come onto the market, how long would it take buyers in the current situation and what's available to exhaust our housing supply? And that's what months of supply really is, right? And so, and as long as I've been doing this, I've never seen inventories these low, and I don't know that anybody has for a very, very long time. So we are on an uptick, though, as far as new listings. Looking at new listings, here's our trend, or cyclical trend. December, drops down to the least amount, once again reflective of the holiday seasons. Same here as December a year ago. And then if you look at this, those are all your December traditionally here in the Twin Cities is the least amount of new listings that are put on because nobody wants to deal with that. But so it's pretty cyclical, pretty standard, and you can see the arches that are so as projected. There's no difference this year that I think is, we're going to see the same thing as we have every year, kind of just what it ends up being. But so right now, new listings as people are starting to put their homes back on the market, getting ready and gearing up for the spring market. And I think a lot of people, what you'll touch on, is some of the rates and how that affects our market also. Not only inventory, but what do rates do and where we're at and where we're going. So so right now, new listings 3554. Like I said, a year ago, where were we at in January? We were at 4,000. So it's close, but it's even less than it was a year ago. And so we'll see where we go. But any questions about that, or what kind of comments, or what? Interesting.
Yeah, I mean, that hopefully that hump increases like it has in previous years. Obviously, I think with rising rates and the home prices staying where they're at, what are your thoughts on if things are going to get more or less competitive this summer? So rising rates and home prices staying roughly the same.
Yeah, it has been, and that's what everybody understands and sees. It's been competitive for buyers. Now, if you're in a position where you've got a home to sell and or a secondary home that you can go to or whatever, I mean, it's an absolute fantastic time for selling. I mean, homes are selling for well above lists, and how you get there, it's multiple offers. It's a proper rollout, and just because of the lack of inventory, there's sellers are really reaping the benefit because of the inventory that's out there. So, I think it's projected to see more of that this year. It's going to continue on. So it's just where you're at in the market and kind of position. But that's kind of where we're at today. But I think we're going to see more of what we've seen in the last couple of years until something else changes. So I know that you had talked about there's some speculation that, and they have, or they're going to, rates will increase. Don't you think here, Justus, coming up, and they have? Maybe you can talk a little bit about that, or.
Yeah, for sure. Yeah, you want to release share screen?
Yep. Let me stop sharing my screen and give it back to you. You should have it.
Yep. Okay.
And go ahead and share some of the items that you might. But.
Yeah, and so Scott, you'll be able to see it on Restream, but so flipping back over to kind of the rate stuff. So let me throw this on here. Let's see. Window capture. Let's get this on there we go. So when we look at like this Freddie Mac data, we'll see a huge uptrend. If you remember other times when we were talking and past podcasts where I said after the start of the year things just took off, well, here's finally that vindication in a chart form of what I was talking about. So you can kind of just see how this thing, January 6th, so it already started raising, and you can just see this huge jump that's occurred with interest rates. If we were quoting someone at the middle of last year in December, 3.125 according to this for the 30-year. Today, 3.55. So, numbers are close, but insignificant is not, especially if you have a large loan amount. That's a pretty big swing. So,
sure.
And if we see this trend continue, following my mouse, it's probably going to go something like this and then like that, because all indicators are pointing that this thing is going to push up into the potentially 4.5 range by the end of the year. Previous predictions said 4. Now they've bumped it up to 4.5. So, that's this thing popping. And keep in mind, so this is saying 3.55 with almost a full point. So point being discount point, meaning you're paying money to get that rate. If you were doing this chart without points, it's probably going to be near the 375, 3875 range. So stuff is definitely going up. Now, keep in mind, these are still exceptionally low rates. They're obviously just not these all-time low rates that we were seeing, in 2021 and 2020. But it does change, how someone gets qualified for a house. So it is something to keep in mind, that if you are looking to buy or sell, that the timing you might want to think about the timing with the interest rates, especially if they are going to go up. Now, a lot of this is determined by the market data that's going to come out, because now that the Fed is essentially backing out of buying up all these bonds, all these mortgages, these mortgage-backed securities that they've been buying up to try and stabilize the market. Now that they're going to be pulling out of that in March completely, keep in mind they were buying 80% of all these loans, where now they're going to be at 0 to 5%. Wow. So that changes, to who's buying these mortgage-backed securities. So there's going to be obviously a lot less buyers, which means there's going to be a lot more volatility in the rates. So the rates could do, this kind of thing. But they're probably still going to slightly go up. So all indicators are pointing that direction.
Will that, in your opinion, Justus, do you think that that'll affect qualification then also, when the lenders know that they can't sell them off to the secondary market? How is that going to affect qualification and or underwriting processes?
Yeah, you might see tightening of guidelines potentially. That kind of stuff happens where when COVID happened, a lot of guidelines changed with self-employed borrowers, because they knew a lot of that stuff was changing. So we had to get a lot more documentation. They had to show a lot more reserves and all that kind of stuff. So potentially with rising rates means potentially changing in guidelines. We actually have seen some lessening of guidelines in the last couple months compared to before, because it's kind of getting through the COVID stuff. But it doesn't mean that couldn't change back. But yeah, it'll definitely, if you were getting a 3% interest rate before and now you're getting a 4% interest rate, well, that's cutting into a lot of your buying power. So then that's going to change your debt to income ratios, and that's going to affect what you qualify for, your max amounts and all that kind of stuff. So yeah, it's definitely going to play a part, in these first time home buyer programs, like the one we use a lot is MHFA. You could get those down payments. So those programs always had slightly higher interest rates than the going average, because the trade-off is that you can get, kind of interest-free money. But those have really taken off. So then usually buyers who are using those programs have tighter qualifications anyway, so then add higher interest rates onto that, and it's going to start kind of a little bit of a pressure stop for potentially some people qualifying.
Sure. What about down payment? I mean, as far as those don't typically change as far as what people need for down payment, the different programs, 3.5% or,
right. Yeah.
Those typically don't change, correct?
Right. Yeah. So FHA's still 3.5. FHA is typically what we use for people who have credit scores below 700. If you're above 700, then we usually go conventional, and that's a 3% down minimum. Yep. And then Bell actually has a 1% down program.
Oh, they do?
Yeah, so that one's pretty handy, and we actually just changed the guidelines today that you can add a community second, in other words, down payment assistance program to it, where before you couldn't, and now you can. So that greatly improves that program now than even where it was before.
I think they're great programs, but I think we're going to have to get some more inventory into the market. For sellers to be willing to, not to say it doesn't happen. I think they're great programs and have helped a lot of buyers and take advantage of those programs. But I think right now the market where it is, and the sellers and their opportunity of selling, they can be a little bit more picky, right?
For sure.
So, yep. But I think they're great programs. But that's. It always changes, evolution of the market, right? Yeah. It's always changing.
Yep. What's
happening. So we probably didn't mean to talk about, but like mortgage insurance and some of those other things, when we're talking about down, if you can get in for a 1% program or even 3.5% or 5%, maybe we could touch on that for some of the people that are um, online, just to talk a little bit about that. I know we didn't really prepare to
Yeah.
talk about that, but mortgage insurance or private mortgage insurance. What is that, or just
Yeah.
to share with people?
A lot of that has changed too since maybe our parents bought homes and whatnot. So mortgage insurance is actually, I view it more as an investing tool nowadays because it allows you to get into a home with less than 20% down, especially on
Yep.
homes that are way more expensive than they used to be. And if you have good credit, mortgage insurance is very inexpensive. Now, if you have poor credit, then that's where we go FHA because they have kind of like a structured mortgage insurance, like maximum, and it just stays there. So you could have a 800 credit score or a 620 credit score. FHA's mortgage insurance stays the same. Where conventional, the better your credit, the cheaper mortgage insurance is because it's all based on a factor. So it matters on how much you put down and then how much your credit score is, or
Wow.
how high your credit score is. So, but if you have really good credit and you're putting 3, 5, 10% down, your mortgage insurance is actually going to be pretty inexpensive.
Well, okay.
And
It's
so,
interesting. I guess I didn't realize that you're and why wouldn't it, right? Because for all of us, our credit is so indicative of everything. Or
huge.
it's I mean, from insurance to borrowing money to everything. I mean, going to the dentist. No, maybe not. But,
Well, and that's why it's so important. Even if you're thinking about buying a house in a year or 2 years from now,
yeah,
getting a plan in place and talking to a professional to make sure that your credit is ready to go, or you have a plan in place to get it to where you want it to be when you go
Sure.
buy, because your credit score is literally everything when it comes to buying a home. It
Sure.
sets you up so much. So like if you know you're gonna be buying a house in a year and your credit's maybe not that good, talking to a professional and getting it to your steps. So like one client I'm working with right now, we just got to score up like 70 points in like 4 months. It's insane.
Really?
Yeah. So he went from not being able to qualify to now he can qualify. We're still going to FHA, but he's almost too conventional in like a 4 month window. It's kind
Wow.
of remarkable.
So
Now they don't always work like that, but this one just happened to.
was it simply by paying off some debt, or looking at pulling up your credit and cleaning up and cleaning up your credit report, or closing some outstanding lines, or what were some of the techniques or some of the tips that you did to improve their scores like that?
Yeah,
Or that they did?
a lot of things you can do is you want to get those credit cards below 20% utilization. If you can get it below 10,
Okay.
that's even better.
Okay.
If you have credit cards that don't require a hard credit pull, you can request credit limit increases like every 6 to 12 months.
Okay.
And then that increases your overall like utilization that you can use.
Sure.
So if you do that on every card and you get $1,000 in it, and you have 5 cards, all of a sudden you have 5,000 more in utilization for your overall credit. There are certain, so I have clients use this, no affiliation or anything, but I have them use like self.inc. So what that program is they have a secured credit card. So secured credit cards work like you give $300 to them as a deposit, then that becomes your credit limit. And the
Okay.
card is designed to build credit. So you obviously want to treat it well, because if you don't, it's designed to build credit. So if you don't treat it well, it'll crush your credit. And then they also have an installment loan version. So think of an installment loan like a car loan, where you make monthly payments on it over your chosen amount of time, and then
Yeah.
it pays itself off. So you're actually paying yourself, because once it gets paid off, you get that money back. Now they do take a small fee from it for their service, but you pay over 2 years, you pay $2,000 in, you're going to get $1,800 back. You give $200 for the service and for improving your credit, and it adds a new trade line, and it's a different type of credit on your credit report, and all of a sudden your credit keeps jumping up. That's
And
specifically
they're reporting to the bureaus. Are they report to the 3 bureaus?
they're reporting to all
What was
3
that
bureaus.
website called? Huh?
Self.inc.
Self.inc.
Yep, and
Okay.
the beautiful thing about that one is they don't do a credit pull to get you qualified and started. So they're not
Okay.
hurting your credit by pulling, but they're establishing your credit going forward. So that client I was talking about, where he's raising his score up like 70 some points, he's
Yeah.
doing that. He got a secured, and he got an installment loan. He raised up his credit limits on his cards, and then he paid them down below 20%. One other thing a lot of people do is they get put on as an authorized user on like a parent's credit card. And
Yeah.
so then you get all that history from the parent who's maybe had that same credit card for 20 years, and all of a sudden your score can jump from that. Now the
So
catch
does
to
that
that
show
is,
up as a trade line for say your child? I mean, that's a great tip.
yeah,
Because
it's huge. Now the key
because
is you want to have it be on like someone you know and trust, like a parent or something. And
here's my card.
yeah,
Oops. No.
well, and the so if you because whatever they charge on that card, it's going to show up on your credit report. So if they have a late on that, you're going to have a late. So you really
Well,
have to trust the person. And it has
I
to be a
mean,
good
when
situation.
so do they? When you say that though, isn't there one billing statement? Doesn't the primary get the statement, and wouldn't you see that and make your normal payments, your auto debit
Yeah.
or whatever? But are they a secondary user or
Yep.
authorized user, or so what is
Yep.
it?
They're a secondary authorized user, so they could technically get their own card and use it, but
Okay.
whoever's the head is responsible for the payments.
Okay.
But it gets reported to both credit bureaus. So, like, if the parent makes a late payment or has a late payment, it's going to reflect on the borrower who's the authorized user. So you really want to have it tied to someone who's taking care
Right,
of
but
their
if you
stuff.
make the payments, if you know that, I mean, obviously, but that's interesting. I'm gonna have to look into that because I've got children of that age that are to the point where they're establishing or trying to establish credit, and there's different techniques, and I think there's a lot of people in this situation where they want to help, their children to establish good credit because it is so important, and this is a great way. I'm glad we talked about it because I actually was looking for sources to say just buy a new car and pay cash for it, but then my daughter's going to pay back that loan or whatever, but it's not reported. It's not,
Right.
and
Right.
even though she's doing that monthly payment, there's no record of it with the bureau. So
Yep.
that's interesting. That's a great tip.
Yeah, another thing would
Cool.
be, especially with young kids, getting them started with like a very small, limited credit card.
Yep.
And so that way they establish how to handle credit and whatnot, and then they can essentially build up on that card. So, like example, I had a credit card that I started when I was in college. I had a $500 limit. I was jacked when I got it. That card has now progressed and like grown up to now it has a $30,000 limit. And
Wow.
and it's progressed from the college card to an adult normal card, but that history is there. So I've had this credit card forever, and so then it helps my credit history, it helps my utilization because it's got 30,000, and I use it once every 6 months, so that way it doesn't essentially become deactivated.
Right.
And then I just use one card.
And then just pay it off or whatever you do, or
use it
So,
use it like a debit card, but then it happens to be a credit card.
right. Do you get miles on that?
Yeah. So so I don't use that one. So for me, for example, so I have like 12 different credit cards. I use
do?
one. Yeah, I use one. I use all those other 11 once every 6 months, so that way they stay active. And so
Yeah.
I could almost buy a very small townhome with all the credit card utilization I have because every 6 months I'm asking for a credit limit increase, and then I'm only really using one of those cards that has the
There's a
benefits.
balance on it, revolving debt or whatever.
Yep.
It's got a balance.
Yep.
So, or open line or open balance. So let me ask you. I mean, that brings up a question to me: is that that all these lines, I don't know, as far as having that much available credit to you. I mean, how is that viewed by an underwriter when you have the capability of borrowing X, whatever that is, 6-7 figures or whatever, how is that viewed upon now? Because you could at any time go out and borrow against that, right?
I could. Yep.
So how is that looked upon? I mean, do you know, or can you speak to that a little bit? I mean, is it a good thing? Because I would think that you wouldn't want that much open line of credit, but apparently it's good for your credit, credit.
Yeah, full disclosure, my scores are like 825.
Okay.
And so how I treat my credit is I have minimum auto payments on everything I have, and then I go in and make manual payments. So that way, if I for whatever reason forget to make, if for whatever reason I forget to make a monthly payment, I know I'm covered because I have auto payment set on. But then by going in and doing manual payments, I am then engaging myself into knowing what I'm spending, seeing what I'm spending,
looking at it,
right? Rather than it being a credit card swipe that you just, swipe it and forget.
So easy.
So easy,
It's
right?
not real money.
Yeah, right. So by doing that, I'm engaged in what I'm doing.
Yeah.
So underwriters actually don't care. So they'll look at the credit report and they
Yeah.
might see these trade lines, but if you have nothing,
If there's zero
no,
balances,
it is what it is.
it
Now,
doesn't go against your debt to income ratio.
right, it doesn't hurt you. So the one catch though is there is a soft pull done towards the end of a loan. So remember when we do the hard loan,
Before we go to
pull up
closing?
forward. Yeah, we do the hard pull up front, so we get the
Yep.
credit report. But there's
Yep.
a soft pull done, and that's why we always recommend don't charge up your cards, because
Yeah.
if all of a sudden that soft pull happens and it's like, oh, charge, you know, all these cards all of a sudden have balances. Well, now you have payments that will reflect,
Right.
that will need to get reflected into your application.
Right. I think we did in one of our first podcasts that we talked about that. I shared a story of that, and the soft pull or the pull. Don't go and buy anything until I tell people.
Yeah, that was the furniture story. That was the furniture story.
You
yeah.
know, until we go to closing, and then I slide over a set of keys, and then I charge it.
Yeah.
Off to the races. But they and I tell everybody, but it. As much as we share with and try and counsel and guide people through the process and say, hey, this is what's coming up. Sometimes not everybody listens and or remembers, and then goes out and charges something up, and a new trade line shows up. And that soft pull comes and is like, oh, yeah, okay, we got to deal with this. So that's another great tip. Just know that not a right way maybe to say it, but under the microscope until you get to closing and get through. Go to closing, then afterwards go buy that Lamborghini, go buy that Corvette.
Not before.
Have at it.
Yeah. Don't buy that before.
No, just don't do it before. If you want a house or a garage to put it in.
Yeah, that's a good point. Yeah.
Interesting. Cool. What else we're going to talk about some other stuff today. I think the big thing that came out since our last episode was townhomes and condos and the addendum amendment that came out, right?
Yeah. So that kind of turned into kind of a little bit of a cluster. So let me share. Let me pull this up. So it's going to show this, and let me move it to.
In the military, there's usually, whenever somebody uses that word cluster, there's usually a word that's behind it, but I'm not going to say what it is. So hopefully it's not that.
Yeah. So this is what we're looking at. So the one thing that they added. So I'll show. Let's see. Let me show this. So if anyone remembers the condo that collapsed down in Florida, it's a pretty scary sight, but you can see that, and you can see that thing going down there just in that quick little video there, but kind of a scary deal. So that kind of like turned into, and this was a while ago, obviously, but that turned into something where new regulations wanted to come out to make sure that these condos who have these associations, have these budgets, are supposed to be doing repairs, supposed to be doing inspections on stuff, to make sure that they're doing that. And so this condo questionnaire the condo questionnaire is done up front just to make sure the financials were all set, and that the bank was investing into a good condo association. Well, now they added this addendum, which is making sure that the condo itself is safe. And so that collapse has kind of like rocked the industry when it comes to condos. So you can see on this, it's all about building safety, soundness, structural integrity. So they're asking questions about, when was it last inspected? Do they have repairs done? And what was done has, more inspection questions. Do they have a budget set aside for the repairs that need to be done? Have they had, all this stuff just to make sure that the actual building is safe? And so
was that filled out or the requirement of the property manager or the association?
Good question. So I'll put this back on us. But the question or these addendums are filled out by the condo association, and a lot of them right now are deferring to lawyers or the board, because they don't want to fill this out because they don't want to technically be liable if these questions aren't answered right. Because in the mortgage process, this form has to be completed in order for you to close. Because when you buy a condo, you get evaluated as a borrower, and the condo gets evaluated as an entity itself. So you could be just fine, but if the condo doesn't pass, you can't buy it.
So is there a deadline, and is it only for condos and townhomes, or Justice, where's that set?
Condos specifically. Townhomes.
Okay.
So townhomes are different because you own the land. So the difference between a condo and townhome is you own the land the building sits on. With a condo, you don't own the land.
You own the space.
You own the space that you're in. So, and you might live in what looks like a townhome, but it's actually a condo. So that's where you have to go through the plans of when this building was first built and how they put it together. And a lot of times you can check on the county, the GIS mapping for your, you go in there and you can search. And if you see it's individually platted for your specific building, then it's a townhome. But if it's like a part of a big
your address, specific address, and so and it's all spelled out typically, and it's not always easy, up front, but typically it's going to be in your association docs and homeowners and some of those things. It'll talk about that, the bylaws and how it was established, when it was established, right? Of what you usually can find it in there.
And it's from the beginning. Yep, that's what kind of establishes it.
Yeah, plat, lot block versus CIC, CIC number is a difference, I guess.
Yeah, so so this change it actually took effect February 1st, and it's okay, and it's been difficult, and it's going to be difficult probably the rest of the year, because I just literally got a review back yesterday that this addendum, they pretty much said, see attachment, wrote a line through everything, and the attachment said, we won't answer these questions right now. It's like, okay, like that doesn't help us. So that's going to be kind of like when TRID came out a number of years ago, and some of these other things. Well, obviously the industry will have to work through that. Yep.
But it'll be interesting to see where that's all going to lead and how much of a fly in the ointment that'll be. So I guess, it's so new that, will loans not be closed or be held in escrow without that document being filed by the associations if you're buying a condo.
Yep. You can't close.
So, and this is not lender. This is a federal guideline, right?
Yep. So it's not like the company I work for. It's just being a stickler on this. This is nationwide, so it doesn't matter. Yeah, it doesn't matter who.
Wow, that's a new up-to-date thing, isn't it? I mean, that's current.
It's kind of a big deal. Yep.
Yeah.
Yep.
Huh, interesting. Huh, all right. Well, cool.
Yeah. Well, anything else to add?
No. I don't know if we had anybody online today or not, but as usual, I always ask people to smash that like button when anybody and or subscribe to our channel. We'll continue to try and bring more tips and tricks and really what's going current and happening in the market in the Twin Cities. So always fun to do. So.
Yeah. Well, yeah. And then obviously we'd like to thank you for watching and listening to the Evolution Real Estate Podcast, where our evolution in our industry never stops.